Is Nvidia doomed to become the Intel and Cisco of the dot-com bubble? Of course, there are a lot of similarities that a lot of people are talking about on the internet, so let's break that down right now. So let's first talk about Intel. I've shown this chart 1,000 times. All-time high on Intel was back on August 28th, 2000 at $75.81 per share. Since then, the stock has not reached its all-time high and surpassed it. Now, a lot of people think, well, the business stinks, all that stuff. Okay, but let's go look at the income statement. Back in 2000, Intel did $33.73 billion in revenue. Last year, they did $55 billion. And this after a drop of like 40% in revenue. Profit-wise, Intel back then did 10.54. Now, in fairness, they only did $4 billion last year, but a lot of restructuring going on. Before this $4 billion, they were making over $20 billion per year. So let me show you guys this in recent years. 21, 21, 21, 20. This is Intel 4 years in a row as of late. So they still had way more profit, over double, but the stock never saw that all-time high. This is a very common theme. Why? Well, as I always say, guys, as every value investor always says, short run stocks are a voting machine. In the long run, they're a weighing machine. What is going to drive the value long-term on a stock is, as long as you pay a reasonable price for the company, as the profit goes up, so will the stock price. Now, another thing I want to show you, going back to that income statement. Let's look at the revenue in the years leading up to it. The dot-com boom. 21, 25, 26.3, 29, 33, down to 26, 26, 30, and that's the last 12 months. So there was growth, right? But I want you to pay attention to that growth there. Let's go take a look at Cisco and compare that to the same situation, because that's really important to understand why, because Cisco had this specific article where Cisco surpassed Microsoft to become the most valuable company, and they said on its way to $1 trillion in market cap. Never got there. Why? Well, like everything we're talking about here, all-time high, March 27th, 2000, $82 a share, has never surpassed it. Okay, now let's go take a look at Cisco's earnings and revenue going back then in 2000. $18.9 billion in revenue in 2000 versus $55 billion in the last 12 months, and profit of $2.67 billion versus $12 billion recently. That's incredible. Almost 5 times more profit in the last year than back in 2000. Yet the stock still has yet to reach its 2000 peak. And it's not like the company sells for 3 times earnings. It's currently selling for 15.5 times earnings. Is that a reasonable price? I don't know. Is that a reasonable multiple? I don't know. But the point we're trying to make here is that when things go parabolic, like they have been lately with Nvidia, is there cause for concern? Parabolic rises are a cause of concern no matter what, even though the fundamentals are getting better. But Nvidia in the last year, up 208%. Year to date, 160%. In the last 5 years, 3,200%. This is incredible, guys. It's back over $3 trillion market cap. It is absolutely killing it. But most importantly, income statement. Look at this income statement, guys. 11, 17, 27, 27, 61, and in the last 12 months, $80 billion in revenue. Revenue is up almost 8x in the last 4 years. 8x. We did not see that with Intel. We did not see that with Cisco. Let's go check out their profit. 2.8, 4.3, 9.8, 4.4, 30, and 43 in the last 12 months. The profit's up 15 times. Maybe 16 times on Nvidia in the last 4 years. Do you see how that's a little bit different than Intel and Cisco? Absolutely. But with that said, I know there's a lot of rumors out there on what is the valuation of the market currently than it was back then. Now I know I'm the channel that feels like I'm being a futster. I'm not being a futster. I own 18, 19 companies in my portfolio and adding to them every single month. Do I think stocks are overpriced? Absolutely. I absolutely do believe they're overpriced. And the biggest overvaluation might be Nvidia. An incredible stat back in 2000. The top 5 companies were 15% of the S&P 500. In 2024, the top 5 companies are 28%. Guys, where the top 5 go, that's where the market's going to go. And you look at the saying, what's the biggest of them all? Nvidia, Apple, Microsoft, Amazon, all these top 5 companies, if they get just a little break in them, that's going to cause the markets to fall. Look at yesterday. Nvidia was down 6% yesterday. The NASDAQ was down significantly with the Dow up. That's interesting to think about. You have to look at that and wonder, okay, this is a heavily concentrated market on top companies. And those top companies are very, very expensive. Does it feel warm and fuzzy because the stocks go up and up and up? Absolutely. But they are expensive nonetheless. Now, here's Nvidia and our 8 pillars. Now remember, guys, the 8 pillars tell a story. These shares outstanding might as well be a green check because 0.04%. This 5-year PE of 235 and 5-year price of free cash flow of nearly 250, that is a cause for concern. But again, profits up 15x. You can't exactly base it on this. The 1-year price of free cash flow is still 79, and the 1-year PE is 72. That is a lot for such a large company. That's a lot of money. It's a big multiple to pay. And this is a constant conversation that we have in our community. And this is exactly why I created the software. I realized that every investment is the present value of all future cash flow. So my determination was, okay, Paul, in order to successfully invest, you need to be able to say, which companies can I determine within a reasonable range of future cash flows? And then how can I use the tools that I have to be able to create that? Now, for those of you who are new to the channel, what you might not realize is this software was purely for me 3 or 4 years ago. And what ended up happening in the YouTube comments was, how do I get the software? And at first I was going, guys, you can't get the software. It's a data feed, etc. Then I realized, well, wait a second, maybe I should make the software. And that's when it clicked. And all this time I've been running the software for myself. But now we have thousands of users, and thousands of users have different tastes in the software. And that's why now we're repositioning the software to be more driven by the user, by you. So as you'll be able to see over time, there'll be changes in the software. We're probably going to split some things apart. There are a lot of tools here, and we want to make sure we don't become the Cheesecake Factory of the software world where you get so much that it becomes overwhelming. So for right now, if you want to get access to all of these, click the link in the description below, go sign up. You get 30 years of financial data. You'll get the stock analyzer tool, which you'll see shortly. You get 8-pillar portfolio, all the 8 pillars, all this data, and more importantly, the community so you can talk to like-minded investors about your thoughts, because investing can be a lonely road. And we've all been there where we felt anxious and upset. What's going on with stocks? They go up, they go down. Am I missing out on the upside? Am I too scared to buy on the downside? These are the things that make great investors. It's not about the numbers, it's about the emotion. And we have a tool here that solves all of that for you. As you can tell, you get all these things: a mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, exclusive content, access to Mo and I, news, 8-pillar portfolio, retirement calculator, EM community with like-minded investors, all of these available. Go click the link in the description below, and I'm sure it'll change the way in which you view money and invest your money. So let's see what the analysts think the future of Nvidia is, because that's probably the hardest part about Nvidia. They're growing revenue so fast, they're growing profits so fast. Is it fleeting? Is it temporary? I mean, you saw with Intel and Cisco, after the dot-com bubble burst, their revenue fell a little bit. Did it rebound eventually? Absolutely. But is this AI thing going to be something forever? I'm sure AI will be around forever. Will the boom be forever? Because guess what, guys? Booms don't happen forever. And there will be other players that enter. There already are other players making chips. Intel alone is starting to make chips for AI. Are they going to be as good as Nvidia? I don't know. But to categorically say they won't be, that's a tough proposition. And I think with Nvidia, the hardest part for me is getting that grasp on what does the future look like 5 or 10 years down the road. And if you don't think that matters, maybe I'm not the channel for you, because it does matter. When you buy a stock, you are buying a piece of a business. You're buying a future stream of cash flow. If you cannot reasonably assess that future cash flow, it's going to be hard to invest. And that's what we're trying to do here. So analysts, now again, they did a 10-for-1 split. So they divided everything by 10. So it's basically going from $1.27 per share this year to $4.55 in 4 or 5 years. That's a big increase. That is some significant increase, but not as much as it has been lately. Because look, this year was 280%. Next year, they're expecting 102%. Big time growth, but is it sustainable for a long period of time? Revenue, big time revenue growth, 60 billion, 115, 148, 170, 200, 206. Again, huge growth. But you got to remember, you can overpay for growth. In fact, that's what usually happens in markets. The markets get super excited about growth and they go pay, stock goes up, and then it stops becoming about the company's growth and it starts to become about the company's stock price. Where is it going next? Remember, I am here to teach a process that you can apply to yourself. You and I will definitely disagree on Nvidia. It's hard to find people who are all going to agree on a company. But if you learn this process of having a margin of safety and every investment to the present value of all future cash flows, the better you are about understanding a business, the better you'll be at valuing the business and the better investor you will be, especially if the stock falls. Nvidia was at 140 recently, 4 days ago. It's now at 125 after being at 118 yesterday. For those of the people who loved it at 140, you should have been unloading at 118. But I doubt that was happening because news follows the stock price. So the question we have to ask ourselves is, what is the reasonable price for Nvidia? Let's look that up now. Now again, line number one, I want everybody to forget the fact that people believe, not the fact, the perception that value investing doesn't care about growth. Value investing absolutely cares about growth. So much, it's the first line in my stock analyzer tool. The point is, two companies that have the same revenue and profit, if one's growing 20% a year, one's growing 5% a year, it is a different value for each company. One company might be a great deal at 10. Another company might be a great deal at 6. I paid a premium for that growth. Don't fall into that trap that value investing is about finding the cigarette butts out there and the crappy companies. It is not. All it is about determining a future set of cash flows, what's that worth to you today, and buying it at a discount to that price today. So I did 10, 20, and 30% revenue growth for the next 10 years. You might disagree. You might agree. I don't know, but that's the point of why we have the art of investing. Profit margin. I did 30, 40, and 50%. Same with free cash flow. And PE, I did 20, 25, and 30. Now, for those who might disagree with that, it's hard to find companies at 80 times earnings that are this mature that would have the kind of valuation of 70 times earnings for a very long period of time. But again, that is the art of investing. It's about how you perceive it to be. If you told me, if God came down to me right now and said, Paul, these are going to be the high numbers for you're going to have 30% growth, 50% margin for the rest of the time in Nvidia. You better believe I'd probably be willing to pay 30 or more. I'd probably be willing to pay more than 30 times earnings, but the future's unknown. We don't know what the future is going to hold. All I can look at is the past and say, has a company ever grown like this before and sustained it? Now, that might not be the right way to look at it, and I'm fine with that. It might be out of my circle of competence. I'm fine with that completely, but you might have a better angle of it on it, and more power to you. One of our analysts, Dalton, he's always pitching me companies. I'm like, I don't get this. And he gets it completely. We don't understand the same companies. I like more companies that create a service or a product that are based on just demand and supply versus commodities. He likes commodities-based businesses. That's for you to determine. But we still look at investments the same way. That's the key of it. We still use the same principles to determine our value and the things we understand. Now, for the last line, what is my desired annual return? Now, guys, 9 or 10% is the market number, market average. So I use this 9% as kind of like my intrinsic value. But of course, you need to have a higher number because this is your margin of safety. And the less you understand, the higher margin safety should be. That's a big key there. So assuming the market average of 9%, hit the analyze button. Here are the values I've come up with for Nvidia based on today's numbers. I have a low price of 30, a high price of 318, and a middle price of 103. Now, these still do assume quite some numbers. So am I really a buyer at 100? I don't know. That's for me to determine. So hopefully this has piqued your interest a little bit on the process of which I use to buy stocks. So if you want to learn more about that, watch this next video. Thank you very much for your time.